Hello, everyone. This is Angie from TechServe Alliance. Welcome to today's webinar, How do high-profit IT and engineering staffing firms manage their P&L? There will be a question and answer session following the presentation, so please write any questions you want answered in the Q&A box, which can be found at the bottom of the screen. We are also recording today's presentation, which will be available on the TechServe Alliance website and distributed to in follow-up emails. Now, I'd like to introduce you to Rick Carlson, Director of TechServe Sales and Recruiting Management Program and President at Harvest Consulting Partners.
Thank you, Angie. Good morning, everyone. Thanks for joining. There's a lot of this whole OPR, if you haven't seen it before, is basically a survey of TechServe member clients and companies that really digs into the fundamentals and numerical and granular idea of what are the things that make companies successful. So there's a lot of material here. I'm going to touch upon a lot, but I'm not going to get too deep into it. So, it's a chance for you to take a look at it later and really dig into it deeper if you like. But really some interesting things that we found from all this. First of all, for those of you who don't know me, I've been in the staffing business for quite a while. I started my own company, which is a consulting firm that works with many IT staffing firms. We develop strategies and sales, recruiting, and business improvement. I'm also director of the TechServe Sales and Recruiting Management Program, which is designed to help producers, recruiters, salespeople, really figure out how to grow your book of business. What are the things that need to be done? How do we break into new accounts? So we work with them on a weekly basis to do just that, grow their book of business and their gross profit. The observations that we'll see today are from the operating practices report for 2021, so the fiscal year. It'll compare some of it to the year prior, although it's a different model of people that are in this one that were in last year. So they're not one-to-one comparisons, but we can take some analysis and look at that. But there's two sections of it. It's a financial analysis, and then there's a sales and recruiting metrics in that section. In the financial analysis, we look at percent of gross profit that drops to EBITDA, very important aspect to look at. We look at positive effects of managing SG&A and how do you manage SG&A. We also look at the other important ratios. I refer to it as effective compensation rate. But what is your plan doing for you? And is it doing what you want? I also look at GP to producer. It tells me different things. When can I add salespeople? When should I add recruiters? It's a good indicator of those. We'll also look at how you measure employee profitability. In the sales and recruiter metrics portion, we'll look at salary trends and associated performances. We'll again delve in a little deeper into when to hire and what are the indicators for you to do that. We'll also look at overcoming higher salary demands. Demands for salary, as all of you are witnessing for sales recruiting, is up naturally within this marketplace. That's what we can expect. But how do we offset that? And then how to build and customize activity expectations. We get asked the question a lot of times: how many of this should they do? How many of that should they do? And rather than just give a generic number or a number that is from other reports, there's ways you can customize that. So we'll look at that. Some real basic stuff here, just so we get our level set here. Revenue, it's the income that you bring in, right? It's every dollar that comes into the organization. Then we have the cost of sales, which is usually related in our business. It's always related to what are we paying the consultants? What other things are we adding that are cost to the consultant? If we subtract that, we get what we call gross margin. Some people call gross profit. I use the term interchangeably, so when I'm talking about gross margin, I may be talking about the percent, or I may be talking about the actual dollars, but either way, it's the revenue minus the cost of sales. Then we look at, once we get gross margin, we take away expenses, our SG&A, sales, general, administrative expenses, and we subtract that out to get our EBITDA. In this particular survey, it's referred to as PBT, or profit before taxes, but I use that term interchangeably, EBITDA and profit before taxes. Quickly, a couple of numbers we all should know is what percentage of our gross profit of revenue. Then we want to know what percentage of our revenue is spent on expenses. Very important number to understand and figure. And finally, when we take the gross margin, we subtract out the expenses, we get our profit and our EBITDA, and we want to know what that is. And we'll look at ways how do we improve that. One other further clarification I want to give you. There's a lot of folks do perm work as well, along with the contract work. And perm work, as you know, is all pretty much all profit. So that can really drive up your GP and artificially inflate it. So I split it out. I want to make sure I know what my contract GP is versus my total GP, so I can watch it on a regular basis. You can see even in this example, which is a live example from a company I ran a few years ago, we were running pretty steady at 22%, 21%, somewhere in that range in our GP. But when you added in the perm, you can see we jumped. I mean, we, if you look over here, up here, I used $582,000 of perm revenue that came in that 5-month period, which really inflates the GP. So I want to make sure I'm not looking at it and saying, boy, we're really doing well. When I look at see my contract GP going down a little bit, I want to make sure I'm watching it. So that's why I split it up. To give you an idea how OPR categorizes staffing companies, there are 4 basic groups that they look at. It's sales under 12 million, sales from 12 to 20 million, sales from 20 to 50, and sales over 50 million. The combination of that group gives us our typical firm, what the typical firm is doing. And from all 4 of those categories, the sales under 12 to sales over 50, we get the high profit firm. And I'll explain what high profit firm is in a second, but that's just, it is a variation from those groups. Interesting, this year, the revenue change went up a good bit overall, about 19%, 18.5%. But depending on the different groups, you can see the sales from 12 to 20 million went up as much as 45%. So we'll look at some of those things. So how is high profit firm determined? Well, it's a pretty basic calculation that we use return on assets managed. And the way we calculate that is we take the EBITDA, or profit before taxes, and divide it by our net sales. Standard calculation for that. We multiply it by our asset turnover. And asset turnover is simply our total assets divided by net sales. So what are our total assets? Those are things like cash, accounts receivable, and inventory, any property we might own, any equipment, hardware, software, that type of stuff. And the 4 indicates that for every dollar of assets I have, I get $4 of sales. So we multiply the profit before taxes times that, and we get a calculation, in this case 25.2. I want to show you what it looks like in all those categories. And you'll see quickly why high profit firms are considered high profit firms. They have a very high profit margin, as you would guess, but they also almost get $5 for every $1 of assets returned, which puts them at a significantly higher return on assets of 56.2%. So that's how it's calculated. You can calculate your own to see where you fall into all these categories. The reason that we measure this is a good indicator of how well you'll be able to survive and prosper. It's quite a bit of excess. I don't want to call it excess because never excess profit, but it allows us to play a little bit differently in the field. I'm going to take a look at the 2 most important things we want to look at is gross profit and sales and general administrative expenses. Traditional here, we have our typical firm with about 16.8. So that's just a median of all the other firms, right? We're running about $16.8 million. We're a high profit firm, averaged about $15.7 million. When you look at the difference, the high profit firms produced $1 million less in revenue. But the key here is when you look at gross margin. The gross margin for the typical firm was running about 27.6%. Now that's up from last year. Last year we were running about 26.5, so almost a full percentage point back up, which is good because we're really focusing on that, trying to bring that in. But look what the high profit firms do. They're 32%, and on less revenue, you're driving almost $400,000 more of gross profit just because you've got that high. Last year, interestingly enough, the high profit firms were running about 27% gross profit. So that's 5 full points, 500 basis points that increased this year. Interestingly enough, when you look at SG&A for the typical firm, it's running about 21.3%. Last year, about 20.7, so not a big jump, about 60 basis points more. But the big jump was here with the high profit firms, and this is not a positive jump. They went from 15.3 last year to 20.3. So they raised 500 basis points, meaning they added a lot more expense to their organization this year. Could have been that they were just taking advantage of the market and adding more production people, sales, recruiting, that kind of stuff. Could be that they moved in different space, got bigger space, who knows? But they added 500 basis points to their expenses, which is, in any organization, you do that, you're going to really suffer on your bottom line. But you can see, because they had such a high GP, they still had less than the typical firm in expenses by $300,000. So for $1 million of difference, $1 million less of revenue, they drove almost $750,000 more in profit. So you can see how important these numbers are and why we track them so closely. The next critical measurement for me always was GP to profit. What percent of my gross margin dollars goes to profit? So the way I do that is I look at, first of all, I take my profit, and we're gonna look at a typical firm. Their profit was $1,058,000, and I divide it by my gross margin, in this case, $4.6 million. And it gives me a target, it gives me a profit of GP to percent to profit, right? What percent of that GP actually, that 4.6 million actually becomes profit? In this case, 22.8. I use a target of 33. I've always wanted to see at least 33%, 1/3 of my GP becomes profit. So in the case for the high profit firms, you can see they're 36.6%, so a good bit more, which obviously drives more EBITDA dollars. If we went to 33% on the typical firm, instead of 22, went to 33, we'd add almost $500,000 of profit. So the importance of managing this is critical. And I say managing because it's not about cutting, it's about how do you manage this. I want to give you a look at what the rest of the organizations look like when you look at GP. First of all, you want to look at the gross profit percent. Some interesting numbers. We already looked at the 27.6, which is what the typical firm is. 32% for high profit firms. Look at the under 12 million, they're 35.4%. But when you look at what drops the profit, they're 20%. They're lower than, they're one of the low, they are the lowest in this case. Well, close to the lowest. I guess the over 12 million, over 50 million is the lowest. But that's because their SG&A is so high. Yeah, if you look at SG&A, it's 28% for them. So there's a cost. The cost of expenses are really what's driving this. So we really want to manage that. We want to see where that is, and you can see most people are in the 20 to 25% range, and you really want to see if you can move that up. As you see that talked about the high profit firms being 36.6, they understand the importance of making sure they get as much of that to drop the profit as possible. Now, where we do business impacts gross profit, obviously. And there are 4 categories that the OPR breaks out for us. They look at revenue from placements through third-party organizations, which only manage the process, the true MSP, VMS. They don't break this out into contact, touch or no touch. So we're going to assume for this sake, it's all VMSs. They look at the second one, which is revenue from placements through third-party organizations, which manage the process and place it and can place their own billable staff. That's a master vendor. That would be if Kforce was running Pfizer, I went under Kforce to put people to work. That's a master vendor. And there's the revenue from end-to-end or end client managed VMS or MSP, and that's the internal gatekeeper. That's Prudential is one of the ones that comes to mind. They have an internal MSP. There is an MSP, but they run it. And then there's the direct relationship, going direct to managers. Now, when I calculate all this, I look at 2 things. I want to see what percent of my business is coming from internal MSP and direct, and obviously direct because I have more control over what's going on. I get better job recs. I talk to the managers. I understand what's missing. But even in an internal MSP, if I have a good relationship, they're gonna let me talk to people. They're gonna let me move around the organization. So I count them as part of this category when I look at it and say, why is everything? Why is it so different? So when I layer in gross profit, you can start to see 77, almost 78% of the business for typical firms comes from these 2 organizations, internal MSP and direct. But what you really want to look at is when you get a really high GP, why is that? Oddly enough, they're running the under 12 million folks are running about 91% of their business through those 2 organizations. Nothing through master vendors, and in a little bit, not much through MSP. As opposed to what's happening over in the over $50 million groups. You're seeing a good, nearly as much there, and a lot more up in the MSP world, which will drive lower gross margin and cause you to have to be much more efficient in your expenses. From where do we source our candidates is the next thing, and it's something we've always looked at. It used to be, I mean, for those of you who've been around a while, it used to be your applicant tracking system, your internal recruiting system was number 1, but that's long gone. It hasn't been number 1 for a while. The best source is by far for sourcing candidates is LinkedIn. You can see across the board, it's the number 1 source. The highest GP producer, which is that under 12 million group, they run about 35%. They're the biggest user of LinkedIn, clearly, but they're the least for referrals, which is interesting, because referrals tend to give you candidates that are more in line with what you want, and hopefully a little bit better GP. So kind of a dichotomy there. Next, second largest is the job boards. When you look at job boards, that's been for a long time right up there. There's number 1 or number 2. Third is referrals, as I mentioned earlier, and then the 4th most common source was what We used to be number one internal recruiting systems for applicant tracking, because those are people we know, right? Those should be one of our best resources. But LinkedIn has become so prevalent in our world, and so common. It is almost an applicant tracking system for us. Quickly, I want to emphasize the importance of SG&A management, because very simple math, right? If my gross margin is 27.6% and I have an operating expense of 21.3, my EBITDA is just a calculation of that. 27.6 minus 21 is 6.3. Across the board. When you look at something like the operating expense over here of the over 50 million, they're at 15.3, which is really good. That's where I really want to be. I want to be between that 15 and 20 number, or closer to 15. But they have to be, because their gross margin is so low. So in order to make any profit, they've got to manage that tightly. So there you can see it runs at 4.7. So just a quick math for you. So where's the best place to go when you're managing expenses? Well, if you break it down, your total SG&A expenses run anywhere 15 to 20 to 25%, 28% is one of the highest. But the makeup of that is all in SG&A payroll. And really, you can't go in there and start cutting payroll because it's not going to help you. It's going to cost you. You're going to have less revenue to work as you cut those kind of payrolls. You're going to lose people. So if it's 70%, it represents 70% of your total expenses. It's the natural place to go to figure out how to squeeze more out of it. Because if you look at total occupancy and total other SG&A expenses, it doesn't add up nearly to what you would get out of there on managing the SG&A payroll. Okay, what's in payroll? Payroll is real simple. It's compensation, right? It's owner, branch, sales, recruiting management, other management, all those, plus accounting and finance and all that, plus benefits and insurance, group insurance, taxes, all that stuff. In this case, it looks at employees who sell, employees who recruit, and other SG&A employees. Whereas on the G&A side, you're looking at pure expenses: marketing, promotion, job board, other sales, other recruiting costs, telephone, business insurance, all those things that you really can't go in and cut too strongly, because it's like one of the owners that I worked for years ago used to say, it's like running a grocery store and saying, I could sell these shelves pretty easily, but if I sell all my shelves, I have nowhere to put the food and the goods. So you go into G&A and cutting there, you got to be careful. You could be cutting out places that would normally help you drive more revenue. So we want to be very careful when cut. So we look at this, and I'm taking this directly from OPR, and you can see they break it down by typical firm and high profit firm. Typical firm is 14.8% of the revenue. That's the cost there. So if I take 14.8% of 16.8, I get $2.5 million. Same in the high profit firm. 13.7 of 15.7 is $2.1 million. So you can see there's a lot more to play with here than there is in the other two areas. So not to say you can't look at SG&A and make some adjustments, but if you'll do better managing your payroll expenses and making sure people are profitable, you'll have a lot more to play with and a lot better opportunity to reduce that number. Okay, so the way I look at it is I call it effective compensation rate. In the OPR, they'll refer to it as personal productivity ratio, PPR. I've always used ECR, and what it tells me is how good is my comp plan? Is my comp plan managing or producing the results that I want it to produce? And so you saw before that the typical firm was 14.7% of sales, but I break it down because I don't want to talk about officer, partner commission, partner compensation, branch management compensation, some of the accounting and finance. I don't want to talk about those because those aren't my producers. I want to look at strictly producers to know if my comp plan is working. So I look at sales management compensation, provided the sales manager is actually doing some business development work. I look at recruiting management, make sure, and I'll use a recruiting manager if in fact that person is recruiting and helping on a daily basis, basically carrying a book of business. And that's what we really look at. Producers are the people that carry a book of business. The formula for this is just taking my producer expense and dividing it by my gross profit. So when you look at we'll look at on the high profit side, when you add up the things that I've highlighted, all in the red box plus the green stars, so I'm leaving out some. Instead of being 13.7, which it was before, it's now 9%, because I've taken out the stuff that really doesn't tell me, it doesn't really impact my compensation plans. So I take all those out and I add up. Now I'm at 9%. 9% of 15.746 million, which is what the high profits produced this year in revenue. It comes out to $1.4 million. And so when I divide 1.4 by 15 million, so that's my calculation. 1.4 is now my total SG&A. It's not my total SG&A, it's my S of SG&A. When I take that and I divide it by my revenue, I get a number that's 28.1. And for me, I have a target range. I like to use 25 to 35, maybe even as high as 40. I want that number somewhere in that range. And I've had them much higher in terms, and I'll explain why sometimes they get higher. But that's going to be my benchmark. I'm going to look at that and say, is that where, am I in that range? If I'm not, I got to dig in a little bit. If I'm below it, if I'm running 20, 19, 18% on this number, it means I'm too low. And what's that? Well, I could be that my compensation plan is a little light. Now, because it's light, it's going to put more EBITDA dollars to me, but it's going to make my salespeople and my recruiters vulnerable. Because if someone comes along with a much better plan, which there are plenty of them out there, if I'm too light on this, I have to risk the chance of losing those folks. If it's too high, maybe that I have too many underperformers, which is usually what it is. It's people that are not really profitable yet. The people that we've got, they might have 3 or 4 people on billing. We're paying them a certain salary. They're getting some commission or maybe even some bonus. And so they're really kind of draining from my gross margin. They're not adding enough to it, and they're taking more out. That's one area. Could be that I have an influx of new hires. And I mentioned in one of the organizations I was with, I took over a region and we were running about 60%. But the reason we're running 60%, we brought in all new people. And of course, new people don't produce a lot of gross profit. They're all cost. So when I get to that number where I get too many new hires, I got to quickly try to get them up to speed. Now, the reality is it could be if I'm running real high, I'm running 60%, it could be my comp plan's too rich. And that's a tough one. Taking money away is never a good plan. And it never results in great things. So we just got to kind of try to see where we stand on that. The other side is you may have comp that for the same comp for high touch, meaning clients where I'm going direct, as I do for people that are working MSP no touch. It's something you got to look at. We certainly don't want to be paying the same kind of comp for work that's totally different. So that's one measurement. Now, if you're going to dig into G&A, I look for aberrations. And I look at it on a monthly basis. I waited for my P&L to come out every month so I could look at things and see what was trending. And the aberrations, the first one is to see the phone. We went from 8 to 7 to 6, and all of a sudden we're 19,000. Why'd that happen? I don't recall what it was, but it happened. We were 10,000 more in 1 month than the normal. I need to understand that. Was that a mistake? Was it something I've done that or someone did something I wasn't aware of? Those are things I look for. Office supplies jumped in 1 month. Legal fees jumped. Not much I can do about that. But I at least want to know, because there are going to be some areas where I can really impact it by making some changes. The second side is, I test for value received. So you see, we had a convention or trade show that cost $27,500 on my top line. Get anything from it, and that's the thing I've got to measure. Am I getting the value of the trade show? How about job boards? You saw we added some a few more subscriptions to job boards, and you can see how much it jumped. It was 9. It was running 12, 11, 9, and now that's 31 and 29. Well, that's okay. I mean, I wanted to do it because I know that can help me, but I got to make sure it's helping me. I got to know what percentage of our jobs are coming out of the new boards we've added, or what percentage of the hires are coming out of new boards we have. Those kind of things. So you can measure certainly, and you can cut. But again, you're not going to start cutting places like, postage and delivery and dues and subscriptions and, consulting fees maybe, but repairs and maintenance, there's some things you just can't do. So you got to be careful when you dig into that. Okay, we're going to look at measuring employee profitability. And we're going to use the assumption that we have a salesperson who's producing about $500,000 annual gross profit. We pay them a salary of about $75,000, and the commission average is about 10%. Then we add taxes, insurance, and benefits, which is 30%, typically for most companies, 30% of the total cost. So we take the salary at 75, 10% of 500,000 is 50 grand in commissions. Benefits is another 30% on top of 125, so it's 37.5. So I have a total cost of that employee of about $162,000. So when I look at the importance of GP that drops the profit, here's where it really hits. Typical firm was 22.8, high profit firm was 36.6. Both companies have the same employee that produced 500,000 annual revenue. But of that 500,000 of annual GP, sorry, not revenue, GP, only 22.8 drops to profit, which means 114,000 is what I've got left over, versus the high profit firm where I've got 183,000 left over. Now I layer in my cost of the employee, which is 162, and suddenly the same employee basically is not profitable on one side and profitable on the other. Now this is oversimplification, but I want you to understand that you got to measure these kind of things and see where you are. This that 48,000 loss may not be a loss at all. But the point being, there's room to help improve and drive more to the bottom line for you. This was last year's survey when they looked at what percentage of salespeople are unprofitable. And last year we were using about $500,000, saying about $500,000, and even a little less than that, about 400,000, between 400 and 500,000 of annual GP is kind of a break-even number. So when you look at this last year, we said 57% of the population, sales population, was producing less than $500,000 of annual GP, which essentially is 10,000 a week for those of you who track weekly GP. Then we calculated 0.5 to 1 million. People had $500,000 to $1 million of GP were about 29%, and then over $1 million was 14. This year we saw some really good improvements. They took a different slice, and I'm not sure why that happened. You can see this big red side is under 750 million. Well, 750 million in annual GP is definitely a profitable person for you. If it's not, we probably need to have a conversation. But that 500 to 750, I don't know how many are in that. But they're profitable. They should be profitable. So we say under that number is 51%, which is a good bit increase better than last year when we started 500,000. So overall, we have 51% under 750 versus 57% last year. We have 20% that are over $1.5 million. We didn't even calculate $1.5 million last year. And look at the number; it's 20% that are over $1.5 million. So good growth. 29% between 75 and 1.5. So if we add the two, the over 1.5 and the between 750 and 1.5, you get 49% that are profitable. And I'll say that in that under 750, you got another few percentage points that are profitable there. So that number is probably more like 52, 53% profitable this year versus 43 last year. So nice improvement. Good to see that people are paying attention to the gross margin, making sure the salespeople are productive. Okay, so, sorry for the eye charts there, but I'll try to make them clean for you. This is revenue sources and types, and I get asked a lot, what percentage of companies, or what percentage of revenue do companies put into perm placement and contract to hire? So if you look here, you see that on the typical firm, it's about a little over 6%, whereas the high profit firms do 10%. And remember, I mentioned the perm fees are almost all profit. So when you drive that much, you can see what it does help your bottom line. Now, we should always measure both sides of it to make sure that our contract business is doing as well. On the other side of this, you see that you see over here before let me come back up. Before you do that, you've got the over 50 million group, which does very little. And again, even if they did more, it might help their GP a little bit. But they do very little because a lot of their money, a lot of their revenue is coming from MSP business, where they may be separated out, MSP versus perm versus contract. Second thing we're looking at, and this shouldn't surprise anybody, because all this information came from IT and engineering companies, so this is the percent of business that is spent there. But I think the interesting thing is down here when you look at other professional staffing and non-professional staffing. I used to refer to it as commercial staffing. There's probably some light industrial mixed in here, but the over 50 million, because they do a lot of MSP work, end up getting into a lot of the other areas. And you can see that's 10% of their business is coming from that area, which also is probably a driver of that lower number as well. So you got to watch that, especially when you get into if you do light industrial. You got to be careful, because that can be very unprofitable business, or less profitable than what you would get from your traditional IT and engineering areas. This next measurement is looking at it talks about billable consultants, and you can dig in this as you wish. I'm not going to dig in too much, but you can see there's under 30 an hour, there's 31 to 50 an hour, and the number is just the average number of billable headcount for each one of the groups. But more importantly, what I'm looking at is down here when you start getting into job orders. I'm big on understanding what's the time to fill. Why is that? Because time to fill could be a tremendous differentiator for you. So we look at the calculator here is days to each of these events. First one is receipt of the rec to the time I submit your candidate. The average is 3 days. Time you get the candidate to the time the client interviews is about 6 days. Interview to client decision. Once they've had the interview, now they make a decision on it, it's 5 days, and the decision starts 14. So all that adds up, in this case, for typical firm 27.7, high profit 36.5. I can't really tell you why they're different, but they're maybe the high profit because they do more direct business. They have maybe there's more time. I don't know. Be interesting to find out a little bit more about it. But you can see it's all across the board, and the reason it's important is every day you leave a job unfilled costs money. So if I can take you from 43.7 days to 27.7, I'm saving you essentially 16 days. 16 days is a lot of money. People get in, once they get into the job, they start producing to the top line. So I want to get them in quicker. So that's why it's important to know. The other thing is it identifies some interesting things. If you look here on decision to start when placed, days when placed. So if you look under the 20 to 50 million, 21.7 days from the time they decide they want the person to the time they start. That's 3. And in this case, meaning this is probably going to be days that are what I call business days, no weekends and holidays. That's 4 weeks to start. Sorry, 4 weeks, a little better than 4 weeks to start. That could be an indicator. If I'm talking to a client, I'm sharing this with them. I say, we have a lot. We do this. They'll look at it and go, "Hey, why does it take us 21.7 days to fill it?" And you go, "It's kind of our question." So we get them to identify problems that we know they have, but they won't admit to. So it's a good indicator for that. Second thing I want to look at is job order fill rate. And you can see across the board, it's about 1 in 4, except over here when you look at the 50 million group. And that 50 million group, it depends on the mix. If it's high MSP business, that number 13.8 is going to be even lower. If you run full MSP, so you're dealing with MSP no contact, and that's the majority of your business, you're going to be lucky to be 5% of your job orders getting filled. And that's simply because there's so many people playing. And you don't have any access to talk about why we're missing on certain things. The last piece I want to look at is this, and this is something that's gone up over years, like most recently. Consultants that fail to report, so they get the offer but then call you up and tell you they're not starting, and consultants that start but fail to finish, they either get fired or they quit. Big number that we should be looking at all the time. We should know what this is, because in the past, if you ran 95% success, 96%, you were doing okay, but not great. Look at this, we're now running 91% success. Over here in the over 50 million, it's 89% success rate. And those are big numbers when you start looking at it, because when I talk about time to fill, what's probably not added back in is when a consultant fails. So it took me 27.5 days to get that consultant, and they failed. I got to put another one in. It's going to take me another 27.5. So the time to fill on that person is more like 55 days. So, and the money adds up, and it's something that can really be a differentiator for us. If we can run somewhere closer to what the under 12 millions run, where it's 3.2, right? So 1% fails to report and 2% fail to finish. Well, it's pretty strong. They're running at 96.8% against guys like this that are running 89. I now have a differentiator because I'm running less time overall. So good thing to know. If you don't know it, good thing to find out. Let's look at sales compensation trends. Since 2017, it hasn't grown a whole lot, 16.7 over the 5-year period, which is a little bit surprising. I would have thought that'd be run a little bit higher, but it's not. It's running about 16% over 2017. Bonus and commission incentive, that's what's really jumped. If you look at that, it's 100% growth in that time period, which is really good. It says you're getting more of your business from, you're paying more of your commission out of the dollars they bring in, and that's really where you want to be. The growth of the GP is up almost 65%. But interestingly enough, if you look, I calculated here what their GP was in 2017, it was 28.7, and in 2021 it's 20.4. And you go, wow, that's 7 points lower. And so that could be costing us. But look at the dollars itself. It's $595,000 versus $361. So, and what that tells me is these groups are probably working in the higher higher end category, meaning higher dollar value category. So to give you an example, if I'm paying someone, if I'm billing someone at 150 an hour, and I'm getting $21, 21% GP, I'm taking in about $32 an hour. Whereas if I'm billing a lower end person, $50 an hour person at 21.4, I'm only taking $14 in. So that's a difference of $18. And it's, that's why the number kind of goes away. The percentage kind of goes away there when you start talking about higher dollar players. And you really want to, you don't want to penalize people on that, because you can see it's 3 times the value if I'm working on a $150 guy versus a traditional $50 an hour person. So something to look at. Key indicators greatly improved year over year. So no surprise, coming out of the pandemic, we were struggling. You could see things were falling off from 2019 to 2020, and they've grown in 2021. Shouldn't be too much surprise. Just want to know that we're taking advantage of contribution dollars were up 44%. Revenue dollars were up 36%. GP is up over 44%. Salaries, we said, is around about 16.7. So all good information, all good news for us. It says we're really managing our business properly. Let's look at the base compensation and talk about a couple of interesting things that this came up. So what they did was they used the median, right? Median, but then they used people that are making their incentive compensation is less than 25% of their total. There's the column of 25 to 50%. Compensation makes up about half, 25 to 50% of your total compensation, salespeople. Then there's the over 50. And the first thing it says is salespeople receive more than 50% of their compensation. So that's this group, right? Produce significantly more GP than those with less than 25. So interestingly enough, because they're making more from it, they understand it, and their focus is more on driving GP percent, GP dollars. I had a great example of this when I was running one of my companies, and one of the sales reps I had really was she was great, but she kept coming in with just different GPs on every deal she made. It was, one was 20%, one was 31%, and the next one was 29%. And I asked her, I said, why the fluctuation? It was all the same client, by the way. And she said, I don't know. It's just the way they come. It's the way the deal comes out. And what she didn't realize was that she was being paid on the GP dollars, and that if she could get average 25% on all of her, she'd make a lot more money than what she was doing with all the difference. So a lot of times it just comes down to the salespeople really understand their comp plan. And they incented by it. So in this case, it is. Now, the people that are 25, when commissions represent less than half the total comp, it's still a 3-to-1 difference in GP produced. You can see it's 950 versus 356. So, we really wanted to get to understand that that's where their money is. And if they manage that properly, it pays a lot more. One of the categories that we look at is GP to producer, which will tell us when we should hire, by the way. Again, we're looking at the same financial overview, right? We've got typical firm, high profit firm. And we're looking at, now we're looking at total producers. And the formula for figuring out GP to producer is very simple. I'm taking my total GP dollars and I'm dividing by the number of producers, and I'm dividing by number of months. In this case, it's going to be 12. So if I take a typical firm, it's 4.636 in my gross margin. I have 12 producers. Now, notice when you count these up, there's 7 sales up above it, 7 sales, 3 recruiters, one other manager, 1 recruiting manager, 1 sales manager. That adds up to 13, but I'm not counting the other management, because the other management isn't a producer. And I'm trying to figure out what my production is. In the high profit firm, it's 12.5, but same thing, it'd be 13.5, but we're leaving out the other management. So I divide my gross margin by my number of producers, and it gives me a number, in this case, 32.2. And what does 32.2 mean? Well, it means this is the average gross margin produced by each of my people. And it's split adjusted. For those of you who haven't heard the word split adjusted before, it's pretty simple. When we get $10 of GP in a deal, typically in most organizations, we give credit to the salesperson of $10, and we give credit to the recruiter of $10, which is basically phantom money. But it doesn't matter. We adjust our comp plan to compensate for that. But that's what I call just what you normally see. This is split adjusted. This says for that same $10, I'm only giving 5 credit to my sales rep and 5 to my recruiter. So I'm giving real dollars. So when you think about a monthly GP, and if we're running 15,000 a month, which is really good, they'd be running 15,000 a week. They'd be running 60,000. This is 64.4 because it's basically double. that. So you got people, your team is producing very well. I use a benchmark down here, or at least a rule of thumb, that if this number were to be below 18%, I'm not hiring anybody. And I used to get people come to my branch managers come to me and say, I want to hire this person, I want to hire that person. And the first thing we look at, and if they're running below 18, I say, you got too many low producers. Yeah, you do one of two things. You either fix the low producers or cut, but you're not adding anybody until you do one or the other. That 18 to 29 was the next category. And that was, we were kind of close, closer to the 20, 25%. I'd say you still got a lot of not producers, but low producers. Let's get them up to speed before we add anybody. Because this is what really drives my gross, my EBITDA, is getting people productive. And then that last category is up to 29,000. Anything over 29,000, I'd say add, because if you think about it, if everybody on average is producing 15,000 a week of GP, 64,000 or 60,000 in a month, you got a busy group, and they're probably missing opportunities. That's why I use that number. In the high profit firm, you'll see it's 33,592. They're running based on this number. So both groups need to add people. Where do you add them? Oh, that's up to you. You look at recruiters and salespeople here. I got a 2.5 to 1 sales to recruiting to sales organization. I'll probably add a salesperson, but it just depends on where you think you need them. But it's a great number to understand, because too many times we add people when we have others who aren't producing, and that's a culture of, hey, they just added someone, I'm not producing, I'm okay, and we don't want to do that. Get asked this question all the time: how many of the activity levels should they have? And I start with gross margin. Gross margin is everything. That's what I want to measure. It's always looking at it from when to add people as to who's productive, who's not. But these are all the steps as you go up the right sides of sales steps that lead to our driving gross margin, right? Clients that we source, daily sales meetings that we've set, job orders that we receive, candidates submitted. How many of those do we need? Well, it depends. It's going to depend on what our gross margin is. Same with the recruiting side. We've got skill sets, pipeline, candidates spoken to, candidates screened. All those things add up to our gross margin, and it's activity in all those categories that we need to drive. I'm going to show you quickly, because this one is breaks down to a lot. But this is sales activity, and what the OPR is showing us. For a senior salesperson, they're saying that on average, on a monthly basis, you should have 26 to 30 meetings. And we're counting virtual meetings, and I want to emphasize, you have to count virtual meetings, because a lot of times it's all you can get. But really what you want to do is this year is really push your people to get more of those client visits, shift those virtual meetings into client visits wherever you can. But they're averaging about 6 to 7 a month for a senior person. Weekly gross profit around 15 grand for a typical firm, 10 grand for the high profit firms. Interesting. Almost 20 grand over here on the sales of 12 to 20 million. Placements, standard 3, 4, 5, 1 to week to 3/4 a week per week. Typical salesperson, a little bit more on the sales visits. Of course, you want to get more up so you can get more opportunities. Placements sitting at 2 to 3 to 1 is 4, but 2 to 3 is about typical for salesperson, an average salesperson. And then the beginning salesperson will always question, right? What should it be? We want to get as many meetings as they can, but that's it's harder for them. It's most of the time we're asking them to prospect and bring new business, so you'll see less of that. Placements pretty across the board, about 1 placement a month. Sorry. But as I say, these are all numbers that that are what other companies are doing, and I say let's calculate our own. Let's look recruiting real quick. Same thing. Recruiters submittals, you want somewhere in that 31 a month. So what is that? It's 7 plus 7.5 a week in submittals, which is about right. Over 50 is crazy. I don't know what happened to that number. I don't know anyone that gets 140 submits in a month. That's 40 a week. I don't see that unless that's the whole team. Don't know what that was. But placements, they're same with recruiters, 3 or 4. They should get 1 a week, somewhere close to 1 a week for the senior folks. For the typical folks, again, same type of submittals. We get a little less productivity as people grow. We're only doing 2 or 3, 1 every other week or so. And of course, the new people. So again, as I said, it's nice to know where people are, but you need to calculate your own. And the way you do it is the way I've always done is I look at these on sales side. I look at submits, interviews, placements, dials, and new job orders. For those of you who know Tom Nunn, I work with Tom Nunn, he calls them JSIPs. And that's what you should be measuring on a weekly basis. Looking at how many submits you got, how many interviews, how many placements, and then and total it up. And what I get is an average for the average each week over the course of the year. So I can start to build out my plan for this person. Like in this case, Terry Ross is almost placing one a week, which is where I want him to be. In order to get one a week, he needs 13.3 submits. So if he comes in with a week of, you look at week number, well, his weeks are all pretty good. But week 41, he's only at 9. He did get a placement, but that's probably because the week before he got 19 submits, right? And he didn't get any placements. So they don't track exactly the same. But I need to know that if he's bringing in less than 13, his chances of making a placement are going to be lower. Likewise, talks about with job orders he needs. So I like to look at that, and I like to do personal prescriptions for people and what activities they should have. Because you look down here at Bill Urbanus, he's brand new, so I can't tell him he's got to have 13 submits and he's got to have 5.8 new job orders. It's not going to happen. I've got to work him up. So what I can do is I look at a team performance and give them at least a benchmark to shoot for. And in team, we do the same thing, right? We look at what percentage of jobs we fill. So we say we had 14 placements. So we divided it by our 52 job orders, and that gives us 26.9, or just about 1 in 4, a little bit worse than that, but we're somewhere in that range. Next, I look at client visits to get a job order. I had 67 client visits, and I came up with 52 job orders. So if I divide that, I figure takes me 1.29 visits to get a job order. Then I look at submits to get an interview. We had 82 submits on this one. We had 39 interviews. Tells me about 2.1 submits to get to an interview. So I have to have just over 2 people submitted to get an interview. And then I look at interviews to make a placement. And once I calculate all this, I look at interviews. My interviews were 39. My placements were 14. It means almost 3 interviews to get a placement. Now I've got the calculation for how do I get people to those numbers. So those are the numbers we just looked at. And I say, if I want 1 placement, down here I say I've got 1 placement. It says I'm going to have 4 job orders. I'm going to have 5.2 client visits, because it takes me 1.29 client visits to get a job order. I need 4 of those. So 1.29 times 4 is 5.2. I need 5.2 client visits from my people. Submits, it takes me 2.1 submits to get an interview, and it takes me almost 3 interviews to make a placement. So 2.1 times 2.79 is about 6. So I need 6, and we're getting about half of our people interviewed. So I know that I need 6 submits to get 3 interviews to make 1 placement. So the math becomes pretty simple. Now, if I want to look at, go for 4 weeks, what do I want? What do I want in a monthly basis? I want one to get every week. I do extrapolations. Instead of 4 job orders, I need 16. Instead of 5.2, I need 21 CVs. So this way, I've got a team one that I can look at and show to my new people. Say, this is where I need you to get to, at least to focus on and target, versus the individual, where I've got people who've been doing this a long time. That one guy you saw was making he was bringing in 5.8 job orders. So he was bringing 20, so it's a little bit more. But the point being, I can customize his or hers rather than make it a group effort. But at least I know they know what they need to do, and it's based on their work, and that's the cute. So I say, don't ask, but calculate. Figure out what it is. Okay, I want to do a quick recap, and then we're going to go to questions. So I call this whole thing protecting profit. Okay, know your numbers, know your GP percent, know your SG&A percent. If you don't know your SG&A percent, you don't know what you need for GP to be profitable. So you need to know that. Know what percent of your GP drops to profit. That's an important one. And target 33%. Try to get yourself to get your business down to running at that level. Manage your SG&A, but mostly your S. And remember, we said target the S being at 15 to 20. Your SG&A, total SG&A, being 15 to 20%. If you're running higher, where can you get more efficient? Again, I'm not big on cutting, because I don't think cutting does the thing you want it to do. It does temporarily, but in the long run hurts you. So manage your folks. Manage your effective compensation rate. Understand it more than manage it. Understand it. Is it right? Are you getting what you want for it? Is it too rich? Is it too light? You have too many people that are unproductive. Calculate employee profitability. And this is what I will sit with people and show them that. I'll say, this is what I'm paying you. This is what it's costing me to run you. This is what you bring in, and this is what falls to profit. And here's where you're profitable or not. I have no problem running that, because I want them to understand it's a business. I'm not hiring people just because I want to pay them. I'm going to hire them because they're going to produce for me, and I want them to produce it 3 and 4 times what I'm paying them. So that's really my goal. We didn't talk about this, but I want to hit on this real quick. MBOs to offset higher salary requests. As we're getting more salary requests that they're higher, I'm not a big fan of paying big salaries. If someone, my goal is 65,000 and someone says, oh, well, Rick, I need 90, I say, okay, I can work with you on that. Here's what I'm going to do. I'm going to pay you 65. So I want to keep my salary consistent throughout my organization. But I'm going to offer 25,000 in MBOs, managed business objectives. And I'm going to give you 5 of them. And over the course of the year, each one's worth 5,000. When you hit them, I'll start paying you. So what I'm doing is I'm setting them up for success, because I'm going to give them stuff like I want them to set a certain amount of meetings, and from those meetings, I want to get a certain amount of those meetings where they sign a customer service agreement where they're going to work with us. I want to get job orders. What percent? How many job orders do I want in a quarter? How many job orders do I want over the course of the year? Those kind of things from them. And then I want to look at how many submits do we get to get interviewed. I'm going to look at those kind of things and build MBOs to it. So I may say, over the course of the year, I want you to get a certain amount of job orders. First quarter, I want you to get 10. Second quarter, I want you to have 15. Third quarter, and I'm going to pay you as you hit those numbers. That way, I'm setting them up that says, okay, next year I'm dropping the MBOs. By the way, you're going to go back to 65 base, but you're now set up for success. I want to track weekly performance and build custom activities based on individual or team performance, but I want to set those up. I want to know time to fill and my failure rates. Those are critical, because those are great differentiators if you're managing those correctly. It's something that your salespeople work. We work with salespeople all the time through the TechServe program, where we teach them when they learn time to fill, how do they calculate that? How do they turn that into real dollars? Because again, what speaks to people isn't anecdotal, we're good. It's, hey, we're 26 days to fill. The competition's running at 43. I'm saving you 17 days. That 17 days is saving you about $34,000 higher. We calculate it. We help calculate it. So those are the kind of things I want them to be able to talk about, because those are the things that get people's attention. Review your GP to producer on a regular basis. Make sure you understand that you've got people that are on rising, people that are doing well, or people that aren't doing well enough, and you either, as I said to my people, you fix or cut. And last, let your P&L guide you when to hire. It's a pretty good indicator. One last note: revenue cures a lot of ills. As long as you bring in profitable revenue, boy, it really changes a lot of these numbers and really helps you change quickly, as opposed to cutting. So if you get more revenue, that's really what it is. I'm going to cut there. I'll turn it over to Angie, and we'll look for questions or answer any questions you've got.
Would you include intangible assets as part of total assets when calculating asset turnover?
Intangible assets, I have to kind of know what they are when you say intangible, because an asset's tangible, right? It's revenue. It's I'm sorry, it's all the things we talked about before. It's accounts receivable, it's inventory, it's property. I don't know what an intangible might be, but we can do it both ways, right? And see what it does for you.
Would you recommend doing a ECR by producer as well as collectively?
Yes, good question. ECR gives you an overall look at how you're doing as a team, and it gives you an indication of whether or not you're getting it. But that whole idea of breaking it down by individual, that you don't have to break it down that far. You can look, right? You can look and see what their GP is and just say, okay, you're less than what it's costing me. But yes, absolutely, because that's what tells you. It's the indicator. It says something's wrong. I'm running 60% on my ECR. Boy, I'm way out of line. Why is that? Now I can look at individuals and say, okay, these are the people we got to fix, or these are the people we got to help.
How can you play with burden to cover some of the operating costs?
Well, a lot of people use an overall burden, 18%, 22%, those kind of numbers. Each state is different because you have different FICA food. Well, FICA is always the same, but FUTA is different. So you do get different ones. So what we used to do is manage exactly what it was based on where that person was placed, what the burden was. So we got a real figure on it. So I don't know if you're playing with it as much as just really getting granular with it and making sure you understand exactly what the burden was for that particular instance. Even though we use a generic 18, 20%, so we can calculate commissions a little bit easier.
Would you include cash borrowed against credit line as part of total assets?
Good question. That one I'll have to get back on. I need an accountant to answer that one. I'm sales, but I've been doing enough of this business that I dabble with the accounting side. But that's a good question. I don't know. I have to get back to you on that one. I'll ask an accountant.
Does the OPR give a timeline of senior, typical, and new recruiters? How long should it take to get to these weekly GM levels?
Yeah, let me look. I've got it in front of me, and I'm just seeing if they got it broken down. I don't think I'm sure they did somewhere. What those timelines are. I'll put this back. I'll look it up and see if I can find what the timelines are for sales and recruiting. I know it's in there, and I just don't have it exactly, but I'll get that and get that back to you on it.
Do you recommend having a different comp plan for salespeople doing new business development versus farming an account? Can you give us an example of what their compensation should look like?
When you're farming an account, you can do it. You can do it differently. For new business development, the tough part about new business development, a lot of people do it is I want true hunters, and I'm going to pay them for breaking into accounts, and I'm going to turn it over to someone. If you're doing that, then definitely it's a different comp plan, because a true hunter doesn't want to play with the day-to-day stuff. They want the kill. They want to go in and get the new account and get a percentage of it. So yes, what we would do in those kind of situations, we didn't have a lot of them because, as you all probably know, there aren't that many pure hunters out there. But when you get them, and that's it, what they want to do is break into new accounts. We would give them, once they break into the account, we would give them a certain percentage of the gross profit over a period of 2 years that they would get paid on, as well as what I call finder's fee, right? You break in and you make it's $3,000 for that, and then you get a certain percentage for as that business grows over a period of 2 years. So that's one way to do it. Farming, farming you can do another way. Another difference that you can use is in farming, you've got a base of your people. You got 15 people working at the account, and to grow that to 20 or 25, those next 5 that you want, the next 5 or 10 that you grow, you can pay a higher percentage on that. So the growth factor is a way to do it. Do I recommend it? If there's any accountants on this call, they're gonna when they hear me say, yeah, I recommend it, they're gonna go crazy because it's calculating different commission plans for different people in the same company. But to me, it's anything that incents them to do the things I want, because I don't want people sitting back and living off of a book of business that they've had for 3 years. I want them to constantly try to grow it, and it gets to a point where they're not going to grow it too much more because there's the constant churn. So it's enough just to keep your 40 or 50 people on billing. It's hard to stay there. So I'm not going to be too concerned. But I get people living on 10 or 15. It's I want to see what I can do to get them incented to either get more business going or look for a different place to work, because I got to get people profitable.
Last question. Have you seen companies put budget for outside interview services to qualify candidates for a client submission?
Read that one again, Angie. Angie, can you read that one?
Yep. I'm sorry. One moment.
Have you seen companies putting budget for outside interview services to qualify candidates for clients? Yes, I have. There's several that do it. If you do that, I count that as part of the gross profit, or count as part of an expense that comes out of gross profit, because as an owner, I'm not, that's part of the cost that I did for that. So make sure you do that. But a lot of people have used that. They've used outside services to basically vet the candidates, make sure they're the right candidates.
That concludes our Q&A. A big thank you to Rick, and thank you all for joining. We ask that you please fill out the survey upon exiting this webinar. Our next scheduled webinar will be, are you ready to propel your growth with M&A? The key steps to getting started in M&A for staffing executives, on Thursday, September 20th at 12:30 p.m. Eastern Standard Time. Also, just a reminder that this year's Executive Summit is scheduled for November 7th through 9th at the La Quinta Resort in Palm Springs, California. If you haven't registered already, then do so soon to take advantage of the advanced rates that end tomorrow, September 9th. Please send any further questions to staff@techservealliance.org. Thank you and have a wonderful day.
Hey, Angie, before you go, there's one last one that probably applies to a lot of people. They're asking, where can you get this presentation? If you let them know.
Yes, they will be sent to you in follow-up emails after the webinar.
Great. Thank you all. Thank you, Angie.
Thank you.